I gave the following prompt to ChatGPT, Gemini, and Grok. Top 10 year-end tax planning moves. Surprisingly, they were pretty much the exact same. Here's the list. Now, if you had more than 10 and included bonus items, I'm going to explain each one of these in a slightly different order than it's on this list because it flows a little better. If you want to skip to a different section, use the bookmarks, which are only available on the YouTube version of this video. All right, here's the list. Maximize retirement accounts, capital loss harvesting, RMDs and QCDs, deduction bunching, charitable contributions, HSA and FSA funding, income deferral or acceleration, annual gift tax exclusion, Roth conversions, estimated tax and W-2 withholdings, SALT deductions and prepayments, and business equipment. Let's start with number one, maximize retirement contributions. Look at how much you've contributed to your company's 401k so far. The maximum amount you can contribute in 2025, if you're under 50 years old, is $23,500. If you've been doing $500 a paycheck, roughly $1K a month, then you are not on track to max it out. Maybe you're okay with that. If you do want to max it out, you will need to log into your company system, increase the amount that you contribute from each paycheck. Remember, once we're in 2026, you will not have a chance to fund your company's 401k. Important note, if you're doing a Mega Backdoor Roth with your company's 401k, you also only have until December 31st to make those contributions. Do some analysis to see if you're on track to max that out. Number two, fund your HSA account. I disagree with calling this a year-end tax planning move because you don't have to do this by December 31st. You have until April 15th of next year. Number three, use up your flexible spending account funds, FSA for short. If you've been contributing to a flexible spending account, often you have to use the money in that account by the end of the year or you lose it. Some plans offer a grace period and allow you to use those funds on qualified medical expenses until March 15th of 2026. If you are struggling with what to buy with your FSA funds, Google, what can I buy with my FSA funds? And you might be surprised. A couple things that stand out are baby monitors, thermometers, condoms, sunscreen, and travel pillows. Number four, tax loss harvesting. If you own stocks or crypto that have gone down in value since you purchased them, you can sell them before the end of the year and create a loss. Up to $3,000 of that loss can be used to offset your ordinary income, like from a W-2. Now, if you can sell stocks with a 10K loss, only 3K of those losses can be used to offset your ordinary income. The remaining 7,000 will be carried forward and can be used in future years. If you sold stocks or crypto earlier in the year at a gain of, let's say, 11,000, then you can use the full $10,000 loss to offset those gains. In that case, you would still have a 1K capital gain. The logic here is that the 3K capital loss limit applies to ordinary income, not to other capital gains. 5, make estimated payments or increase your withholdings. If you don't pay the IRS enough in taxes during the year, they can penalize you. Please see my video titled, Do You Have to Make Quarterly Tax Payments, for more details. Defer or accelerate income. A lot of people don't have this choice. If you do, a key point of consideration is what tax bracket you are in this year versus what tax bracket you think you will be in next year. For example, if you received a huge bonus this year, that is putting you in a high tax bracket, and you know you will be in a lower tax bracket next year, consider deferring income into next year where you will pay less taxes on that income. A few examples of the types of income that can be deferred or accelerated are sales of property or stocks, business income, or payments between your own businesses. Number 7, lifetime gift tax exemption. Two types of people come to mind who should consider this. Number 1, people who believe they will die with more than $14 million in assets. These people often have a need to get stuff out of their taxable estate. They can do this by giving away $19,000 to as many people as they want, including me, during the year. Then they will die with less money and a smaller taxable estate. Number 2, if you want to give your kids or someone else cash and you don't want to file a gift tax return, you have until December 31st to give $19K to as many people as you want, including me, and you will not have to file a gift tax return. If you give one person $20,000 in one calendar year, then you have to file a gift tax return. Filing a gift tax return does not necessarily mean that you have to pay gift tax, and usually you don't have to pay gift tax. Let's say you want to help your daughter and her husband with a down payment on a house that they will be buying in 2026. Let's say you are married. You and your spouse can each give your daughter and her husband 19K each in 2025. Then on January 1st, 26, you can do it again. In this example, daughter and husband would each receive 38K, 19K from you, 19K from your spouse in 2025, and then another 38K each in 2026. This would be a total of 76K per year. Number 8, SALT deductions. SALT stands for state and local taxes. The deduction you can take for state and local taxes has gone up from $10,000 in 2024 to $40,000 in 2025. What this means is that you can potentially prepay your 2026 property taxes in 25 and get a much larger deduction on your 25 tax return. Two situations come to mind where this would make sense. Number 1, prepaying this amount is the only way that you will have enough itemized deductions to itemize. If you don't prepay it, you won't be itemizing. When you don't have enough itemized deductions, then you take the standard deduction. Not the end of the world, but an important consideration. Number 2, if you will be in a higher tax bracket in 2025 and the prepayment will mean you are itemizing, then it probably makes sense to do so. One other situation that may benefit from this increased SALT deduction is if you are in a no tax state. Texas, Florida, Washington, to name a few. If you're debating between buying a new car or boat or other big ticket item this year or next, then you want to analyze which year will provide you the biggest tax benefit. Why? Because you might be able to deduct the sales tax on the new boat or car. Number 9, take your required minimum distributions, RMDs for short. If you are 73 years old or older, have an inherited pre-tax IRA, then you're required to withdraw a certain amount from those accounts. This amount must be withdrawn by December 31st or you will get hit with a penalty. Number 10, charitable contributions. Qualified charitable distributions, QCDs for short. In 2025, you can donate up to $108,000 from your pre-tax IRA directly to a charity and you will not have to pay tax on it. This might make sense for charitably minded people who have a large IRA balance that they really don't need. This QCD would satisfy your RMD amount. Donation bunching. Let's say you typically donate 5K a year. That 5K a year donation may or may not help you on your taxes. If you don't itemize, it is not helping you. In some cases, bunching your charitable contributions into 1 year might be the difference that moves the needle on your tax return. So, while 5K of donations would not reduce your taxes at all, a 10K total donation for the year would reduce your tax bill. The idea is that instead of donating 5K a year, you do 10K 1 year, skip a year, and then do another 10K in year 3. Some people even like to do 3 years worth of charitable giving in 1 year. Another option is a donor advised fund, DAF for short. Let's say that you really prefer donating to your favorite charities every year, but you want the tax deduction in 2025. Consider a DAF. A DAF is essentially an account that would allow you to contribute a large chunk this year and then make donations to the charities in later years. For example, you would contribute $15,000 in 2025 and get a $15,000 charitable deduction. Then in 26 and 27, you could donate the money in the DAF to the charities of your choice. Number 11, Roth conversions. A couple questions to ask yourself here. Will you be in a lower tax bracket than you normally are in 2025? For example, you are in the 22 or 24% bracket this year and you believe you will be in a higher bracket in 2026 and beyond. Maybe you quit your high paying job to work at a startup. Maybe you got laid off or took a long break. Maybe your business did not do well this year. Or maybe you are doing great, but you think you will be doing even better next year and for the foreseeable future. Consider converting up to the top of the 22, maybe 24% bracket. Now, your age, the balances of your pre-tax and Roth accounts may impact this analysis. Second important consideration is, do you have the cash outside of retirement accounts to pay the tax bill for your conversion? If you convert to a Roth, it's a taxable event. Ideally, you don't want to use cash in your retirement accounts to pay this tax bill. Number 12, business equipment. You can potentially expense up to 100% of the purchase of certain business equipment. Things like office and computer equipment, software, heavy machinery. Business vehicles qualify for large deductions but have some different limitations. Now, there are trade-offs with expensing it all now versus spreading it out over the next few years. For example, let's say you plan to make $500,000 of profit in 25 and hope to make $800,000 in 2026 and to continue to grow every year thereafter. Well, if you write off 100% of new equipment in 2025, you will have less to write off in 2026 when you're in an even higher tax bracket. The logic here is that you have the option to spread this depreciation deduction over the next 5 years or take it all in 2025, where you think your tax bracket will be this year versus the next few years, and what other deduction options you think you will have during the next few years are all important considerations. The good news is that you do not have to decide in 2025 exactly how much you will expense and what depreciation method you will use. You can run calculations when you are preparing your 2026 return, your 2025 return in 2026 and make a decision then. Even though you have until you file your return in 2026 to make these decisions, you do have to purchase the equipment in 2025.